Equity markets up, interest rates on their way down, and underlying it all, a growing federal deficit and an AI tech revolution. This is a special edition of Wall Street Week, looking back on the first half of 2024. I'm David Weston. We talked with investors and who those investors listened to through the year. And we'll revisit some of the most memorable conversations with Mary Daly of the San Francisco Fed, Marc Rowan of Apollo, Blair Effron of Centerview Partners, and Niall Ferguson of the Hoover Institution. We start with former Treasury Secretary Bob Rubin and an issue he's been working on since he first joined the Clinton administration back in 1993, the growing federal debt, something that hasn't gotten better, and he says has gotten much worse.
I think that the risks are even greater today because our debt-GDP ratio is CBO estimates at about 100% right now. It's the highest in the history of the country, except for 1946 and 47, when we were coming back out of World War II. I think the risks are enormous, and some of them are materializing already, like higher interest rates and effect on inflation, in part, not in full. And others haven't materialized yet, but I think they're out there, and sooner or later will materialize if we don't correct our fiscal trajectory.
You talked about some of the market indicators and even forces that you saw in '93 that sort of pointed you in a direction, pointed President Clinton in the direction of really making the deficit a threshold issue. Are we seeing those indicators of those forces today in the markets?
I think that we are seeing the effects, but it's unfortunately, from a political point of view, David, I don't think they're getting connected in a meaningful way, with deficit reduction. Sure, interest. I mean, the 10-year was about, I think, 1.5%, say, 2 years ago. And now it's about 4.5%. Now, that's a lot of factors that go into that. But I think part of it is our fiscal situation and the effect that's had on inflation. I think it's been an aggravator of, or, if you will, an effect on inflation. And I think there's a general concern about the imbalance between supply and demand for savings and the excess demand that's created by our deficits. But it's not, unfortunately, from a political point of view, I don't think the dots are being connected the way they were back in 92-3 when we acted. Well, 93 we acted, but 92 when President Clinton was putting his plans together.
There's a lot of talk these days when we talk about the Fed about the neutral rate and a debate about whether is the neutral rate higher. And I guess my question is, does the deficit and the debt normally, all the things being equal, drive the neutral rate higher?
I think over time. But I think you can also have a long period of time, and we had a long period of time, David. We had actually a long, long period of time, during which all this was having little effect. And then all of a sudden, the 10-year went, as I said a moment ago, from roughly 1.5 to roughly 4.5. And I've been around markets and these policies for 5 decades now. And there certainly are periods when you can have a long time when reality is out of, or what's happening is out of sync with reality. But that doesn't go on forever, and when it corrects, it can correct savagely. A good example was the Eurozone, the sovereign Eurozone crisis. For years, the Greek bonds traded, roughly speaking, parity, with give or take, with German bonds, and then all of a sudden it exploded. And I think it's a good example of how what isn't sensible ultimately doesn't continue.
There's the politics of it, which I want to talk about. Before that, let's talk about the approach taken to it. Let's talk about, for example, the Biden administration. We can talk about the Trump administration if you want,
sure.
But the Biden administration. When you were there back in the 90s, you came from Goldman Sachs. You had other people there who knew the markets pretty well. There was a healthy dose of how are the markets reacting to this, what does that do for us? Do we still have that, or is it more ideologically driven? Because some people think we've sort of shifted the orientation, particularly the Democratic Party, more toward protectionism, more toward populism.
Well, you've asked multiple questions, so I'll give you my view. I've given a lot of thought to this, and I know the people there pretty well. If you look at the proposals, but I want to respond to something you said that's a little different. Well, I'll get to that in a second. If you look at the proposals, the major policy proposals that President Biden made, they were all paid for in the proposals. Now, ultimately, they had to go through Congress, and when they went through Congress, they came out, some of them paid for and some of them not. I think he's okay. I think he's actually pretty good on this. I think there are other issues where I might have a different view than he does, or maybe I would have let's say an altered view rather than a different view. But I think on fiscal stuff, actually, he's got a pretty good sense of it. I think on the proposals, they had 3 major bills, IRA, CHIPS, and infrastructure. And in the original proposal, and then, of course, before that, Build Back Better. And all of those, if you look at this is correct, because I looked at them, in all of those, the proposals were fully paid for. They had to go through Congress, and in Congress, in some cases, they lost the pay for it. You mentioned, I've forgotten how you put it now before, but did you say populism or progressive?
Populism, yeah.
Yeah, populism. If you look at what is being referred to as industrial policy, and they refer to as industrial policy, it's their label,
yes.
But it's not picking winners and losers. Now, it may be in the minds of some of those people, but if you look at those proposals, and I've talked to their people about this a lot, I think they actually make a lot of sense on a purely economic basis. They're externalities. They basically dealt with with insecurities in our system, in our economic system, with respect to our economic security, our economic functioning, our geopolitical or national security functioning, that markets were not going to meet and had to be met by government. So that, I think, is not industrial policy in the traditional sense of let's pick winners and losers. It was let's fill holes that the private sector simply isn't filling, and those are holes of economic and national security.
So from your perspective, the overall approach you don't take much issue with.
No, I really
So how do we
don't.
end up with where we are, where we have increasing deficits and increasing debt?
Oh, well, wait a minute. What I talked about was the proposals he made.
Yes.
No, I think we're in a terrible place, David, because unfortunately, once you get to legislating, there isn't the will. There's a lot of talk, but the talk is always divided politically between the Republicans who refuse to raise taxes and the Democrats who won't deal with entitlements. Now, I think there is a reality to this, and that is I do think when we eventually get to doing this, or if we were to do it after the next election, which the good Lord would hope we will, but I wouldn't bet on it, about 60% or something of the increase in the debt from 2000 to 2022 was because of the tax cuts. So if it hadn't been for that, the debt, instead of being 100% GDP, would be about 60%. Another way to look at it is exactly what I just said, which is what percentage of debt, what percent would the debt be of GDP if we had the two tax cuts? And you come out to about the same number, around 63%, something like that. So I think in very large measure, what happened is we had two very big tax cuts, neither of which were paid for. So we decided not to pay for what we were spending, and that's how we got where we are. But looking forward, we're going to have to deal with both spending and taxes. So I think for the reasons I just said, when you get realistic about it, I think you're going to have to be largely on the tax side.
On the tax cuts, the theory of that was to increase productivity, increase growth. Can we grow our way out of the problem?
No, but let's go back one step. When the Trump tax cuts were enacted, one of the major investment banks put out a piece saying that on a 10-year basis, they thought that the tax cuts had zero effect on investment and productivity and growth. Now, that's the tax cuts in terms of their impact. On the other hand, what it did do was contribute greatly to our deficits. Look, if we could put in place a serious inclusive growth strategy and increase our rate of growth, that would certainly help because that goes debt over GDP. So that would help. But I still think we're going to have to deal with our expending, but even mostly with our taxes.
That was former Secretary of the Treasury, Bob Rubin. Coming up, we turn from the federal government borrowing money to the appetite for companies borrowing to finance deals with Blair Effron of Centerview Partners. That's next on Wall Street Week on Bloomberg. This is a special end-of-summer edition of Wall Street Week, looking back on the first half of 2024 and forward to what the rest of the year holds for investors. I'm David Weston. Private equity slowed down a lot in response to over 500 basis points added to interest rates and a good deal of uncertainty about where the economy is headed. But it's starting to pick back up, and the much-anticipated Fed cuts expected this fall should only help. When we talked with Blair Effron of Centerview Partners earlier in the year, he predicted that when the year is over, it will prove to have been a good one for his core business.
I think private equity will be a very strong driver in 2024. If you think about the years preceding 2023, it was basically 40% of the market. There is such a large group of companies that are looking for liquidity and coming from private equity that I do think it'll be a very active time. And again, that goes directly to the financing markets as well. The financing arena will be more liquid than it was last year. And we're seeing most of the private equity world think about being more active. And frankly, to their credit, they slowed down activity at a moment when they should. Last year it was much easier for a corporate to look at something and not think they had private equity competition. This year, when we see companies we're selling, the interest is both corporate, we're already saying it, corporate and private equity.
How much of your business in merger and acquisition is driven by essentially the need to reform parts of a sector? I mean, I'm thinking of one that I come out of media right now. There's a lot of pressure right now for some of the big media companies to really think about the cards they've got and how they deal with them and how they get rid of some, how they pick some up. How much of M&A is really driven by these big companies saying, you know, we got to really restructure?
Today, I think it's most of it. Transformation is happening so quickly and is so disruptive that every company is saying, here's my portfolio today, but where's it going to be tomorrow? So even when you talked about your world, media. It used to be traditional media with 3 networks. Now it's traditional and non-traditional players. Apple, Google, Amazon are as active as Disney, Comcast, Paramount. Gaming, what is technology? It all becomes one industry. If I go across any industry, that is what we see. I look at the pharma world. The fact is, life sciences is one of the biggest areas out there. Why? Because we have such innovation going on in this country. So many companies you never heard of 5 years ago and never heard of that have become really important just 5 years later, that this becomes a window. When you think about R&D for a big pharma company, it's more interesting in many ways to buy than build. So I would say that every business is being challenged in ways it never was before. And it's causing CEOs, it's causing boards, causing seasoned leaders to constantly rethink their ideal portfolio, recognizing there is never an end-state portfolio anymore. It is always going to be evolving. And the good news is we have as talented and experienced a group of leaders as ever. So when a CEO undertakes M&A today, chances are strong that he or she is going to end up doing a good job and the right thing for the company, both strategically and financially.
All of which supports your view that 2024 looks like it'll be a lot stronger than 2023 in mergers and acquisitions. What does that say for Centerview Partners? Are you hiring? And if you are hiring, what sorts of people you're hiring? Because it looks very different than it did certainly 10 years ago, maybe 5 years ago, because of some innovation, not to speak of, for example, generative AI.
Boy, that's a great question. First of all, we are hiring, so anybody has a resume, let us know. We're always hiring. The skill set we look for is probably different than you would think. We want people who can think critically, who can analyze situations, who have judgment, have an ability to make difficult problems distilled into more simple problems. And it's less about whether you can make a great model. I do think when AI, over time, will replace some of the skill sets that we see traditionally done in STEM, coding, for example. I'm not sure that if I was, I'd be advising my kids that learning how to be great coders is going to matter in 10 years. What will matter is, do you have judgment? Do you have an ability to think critically, as I mentioned? And ask questions that need to be asked, that you can see situations of what am I missing? And I think that is a skill set that people are going to find is increasingly important. And you also have the skill set that says, I'm going to have 3 careers. What do I need to know to have 3 careers over my professional span?
That was Blair Effron of Centerview Partners. Coming up, the United States is doubling down on chip production. We talk with San Francisco Fed President Mary Daly about how her district is helping to lead the way, and not just in Silicon Valley. That's next on Wall Street Week on Bloomberg. This is a mid-year special edition of Wall Street Week, reviewing some of the best interviews we've done so far in 2024. One of the big themes of the year has been the United States' investment in microchip manufacturing. And when we think tech, we tend to focus on Silicon Valley. But Mary Daly, the Fed president whose district includes Northern California, told us that is only the beginning of the story.
It is not just Silicon Valley. You can go to Oregon. That's the home of chip manufacturing and has been for 2 decades or more. We have Silicon Slopes in Salt Lake City, a burgeoning community. Even in periods, and people think of it as Northern California, but LA has a considerable amount of tech, and Boise, Idaho is building itself up as a tech center. Now, they all do different kinds of things, but to suggest that Silicon Valley's the only thing out there is really a misnomer.
So an important contributor to your part of the economy, which is a substantial part of the economy, is tech. Is it growing?
It is growing. Now, it's interesting because there's been some layoffs in tech, there's been some rebalancing of companies, and that makes people afraid that tech is falling. And I always remind people there's a difference in growing less quickly than you used to or you might want to, and the level. And tech is still a very good investment. There's a lot of interest in it. There's a lot of jobs out there available to it. And with the AI and generative AI boom of interest, we're seeing a lot of investments in that space alone. And again, it's not just in the Gen AI, it's in autonomous vehicles, it's in predictive learning models and what that can do for businesses. So there's just a lot of interest, and I think it's fueling those booms.
So tech has been driving the equity markets for a while now, and it's very exciting. How do you avoid a bubble?
So tech goes through times of overvaluation and times of repricing, and we've seen a variety of those over time. And I think that's just a sense of the enthusiasm for the idea, and then the understanding that there's a practice that has to go with it to make it live, right? So the companies, a lot of companies, I lived through the dot-com boom. A lot of companies had great ideas and high valuations, and then of course, only a handful of those ideas were really lasting. And so I think there's just a normal amount of run-ups and come-downs that go on in tech. But the fundamental idea of tech is it continues to grow through that.
What is the reason why you have such a concentration of tech in your district? I mean, we tend to think of Silicon Valley as being close to Stanford and Berkeley and some universities. Is it the educational system there? Is it some other factors? Is it just critical mass?
I think there is a bit of critical mass, and there's a number of research studies that say, these network effects are large. So one of the things we've seen is, and you see this anywhere in the country really, is that people might start in Silicon Valley, they might start in Austin, Texas, they might start in Boston, but then they move. Family things take them other places. We have a lot of lovely states to live in, so people go other places. And then they build those tech centers around them because they have the expertise. And certainly that's what happened in Salt Lake City. It's a tremendously desirable place to live. People moved from California oftentimes, worked with the population, a very well-educated population, very enthusiastic population, and so they took this up. And you see this forming. And I think that's a natural progression of any kind of an industry, but there is a great enthusiasm in the West for tech. And it's not just in California, the coastal states. I always remind people that the 12th district has the intermountain states, Nevada, Utah, Idaho, Arizona. Those states are equally enthusiastic about tech. I was visiting UNLV, University of Nevada, Las Vegas, and they have a big and burgeoning tech center and entrepreneurship in tech. And it just reminds us that so many good ideas are taking place, and so many people want to work in that space that it can be anywhere in the United States, not just Silicon Valley.
So let's turn to another area that's really prominent in your district, and that is commercial real estate, which has gone through a bit of a tough time, at least parts of it have, in part because of the increase in the interest rates. Give us your sense about where commercial real estate is in your district today.
So one thing that you learn quickly in the 12th district, and I'd say other places in the country, is that commercial real estate's a big name for a lot of different segments. So if you're in industrial and warehousing space, you're feeling very good about things right now. If you're in retail space, or even multifamily housing out in suburban areas, then you're feeling really good, you're confident. The place where you're seeing weakness, and everybody knows it, is in the urban cores of particularly cities like Seattle, Portland, San Francisco. LA is doing a little bit better, but you can find pockets of this in LA. And that has to do with the fact that a lot of people are still working from home in those communities. Those big office complexes that were built up for those individuals to work in, they just aren't, they're not filled. And so there will be a repricing and a resettlement. The thing is, we've known it's coming for a while, and I see private equity money, venture money sitting on the sidelines, ready to come in when the price is right. So there'll be some repricing, there'll be some loss of valuations for sure. but it doesn't seem today to be the kind of disorderly adjustment that you would worry about. It's something that is more orderly, even though it's certainly going to be painful for those involved. It's not is likely to be as disruptive. So even though I'm saying all of that, it's something we have to keep our eyes sharply focused on. So it's a primary area where I am, spend a lot of time talking to people about it to see how are people feeling. But today, they feel a little more positive than they did back in October, when the 10-year had gone up close to 5.
Is it big enough or integrated enough into the economy to actually have some suppressive effect on overall growth?
I think that the change in valuations will be something that that investors and owners will feel. But in terms of overall growth, it's one person's loss, if you will, is another person's gain. So if another investor comes in and says San Francisco is a highly desirable place to live, it's a desirable place to work, it has these very well-educated, very enthusiastic entrepreneur population, then I think that rebalances things, and it helps boost growth. So I don't see it as a negative on growth. I just see it as a rebalancing that we have to watch and look for instabilities that might form.
One of the concerns is about regional banks, which tend to be more exposed to really commercial real estate. And then we've heard about that from the Fed in Washington,
Absolutely.
Some concern about that. How do you assess it out there? You have a little experience with this, with Silicon Valley Bank and things like that. Well, how do you assess the risk for the banks, the regional banks?
Yeah, so I would separate the failure of Silicon Valley Bank, Signature Bank, and First Republic, which really they all three had the same experience, which is depositors who were uninsured ran. And that's a different situation than the commercial real estate. But what that situation did, is it alerted all investors and depositors to the fact that there's a portfolio underlying the health of a bank, and we should focus on that portfolio. I think it's useful to remind people, too, we have over 4,500 banks in the United States and only 3 failed. So the banking system is safe and sound and resilient, but there will be adjustments. And one of the things that you've heard the Vice Chair of Supervision, Michael Barr, speak about, and the FDIC chair and OCC, is really focusing their efforts on ensuring that banks are preparing for those adjustments. So it's certainly there. The final thing, though, that I think is really often not known is that regional banks don't have a lot in these big urban core office buildings. Those are really investor owned. And so it's useful to separate the concerns you might have about regional banks on commercial real estate from those big, monolithic empty buildings that everybody's worried won't get filled.
Did you change anything the way you supervise banks after Silicon Valley Bank and the others?
So certainly, I'm going to refer back to the Vice Chair of Supervision, Michael Barr, here, because the Reserve Bank presidents, and it's perhaps an underknown fact, we don't have a role in setting regulatory or supervisory programs or policies. That's done at the Board of Governors, and then the teams in the Reserve Banks execute on those. So with that in mind, though, of course, every reserve bank in the country, including San Francisco, is actively working with the vice chair and his teams in D.C. to shore up our supervision. We have the force, speed, and agility. You're speedy. You're spotting things around the corner. Agile, moving in the situation, taking in the risks and figuring out how to interact with the firms. And that's definitely something that the Federal Reserve writ large is 100% focused on. And when we talk to our colleagues at the FDIC and OCC, some things that they're focused on as well.
That was Mary Daly, president of the San Francisco Federal Reserve. Coming up, looking down the road at a world where there aren't too many people, but far too few. Something Niall Ferguson of the Hoover Institution is warning investors about. That's next on Wall Street Week on Bloomberg. This is a special edition of Wall Street Week, looking back on themes we talked about in the first half of 2024. I'm David Weston. We've spent a good part of the year so far with presidential candidates talking about what to do about too many people coming across the border between Mexico and the United States. But Niall Ferguson says we're overlooking the much longer and more disturbing trend, the decline in birth rates through much of the world that threatens economic growth by giving us too few workers. We talked with him about how big a problem it is and what could be done about it.
Well, David, when you and I were young, the world worried about a population bomb. There was going to be a Malthusian crisis named after the great 18th century political economist Thomas Malthus, where overpopulation would lead to famine and disaster. And it was those ideas back in the 60s and 70s that led to some pretty drastic population policies, not least the one-child policy in China. Well, fast forward to the 2020s, and it turns out that the law of unintended consequences has struck again. And we now are facing significant population declines, not only in Asian countries that drastically reduced family size, but right across the globe, except in Africa. And it looks as if, although you can debate the exact timing, humanity will peak in the 2060s. We'll get to the maximum population probably some way below the 10 billion mark. And after that, population is going to decline, and decline pretty steeply. This is most easy to illustrate with the case of China, where the population is forecast to decline by half, by 50% between now and the end of the century. But it's not just a Chinese story. Ultimately, it's a global story. And this is one of these trends that I think most people haven't fully grasped, because it's just a little bit out of the average person's planning horizon, the 2060s.
So what happened? Why is it that we have, in fact, the fertility rates going down the way they are in so many countries around the world?
Well, that's not the easiest question I've been asked today, because explaining why, in all kinds of different contexts, couples have chosen to reduce the number of children that they have below the replacement rate. Now, it's typically said that the average couple has to have 2.1 children. Yes, I know there's no such thing as 0.1 of a child, but just above 2 for us to maintain population, because obviously there are some people who die prematurely, perhaps even in childhood. So the replacement rate's 2.1 per couple, but all over the world, couples have taken that number down below 2. Indeed, in countries like South Korea, the fertility rate is below 1 on average. And so the one-child family has become pretty much the norm in East Asia, and it's rapidly spreading around the world. Population in the United States has continued to grow only because of immigration. It's not because of natural increase, because in the United States, as in most Western countries, the average fertility rate fell some time ago below 2.1. Now, why is that? I mean, there are all kinds of explanations that you can advance. Maybe the attitudes of women changed to family size because women began to pursue more ambitious careers in the wake of feminism. Or maybe it's just that as societies become more economically advanced, people decide to spend their resources not on having more children, but on having more vacations or acquiring yachts and McMansions. There are a bunch of different explanations at work here. I was drilling down into the South Korean case, and the answer that I got from the South Koreans I talked to was, well, it's just so expensive to raise kids in Seoul these days. We spend a fortune on educating our one kid. We just can't imagine doing it for 2. And, you know, you have to ask yourself what the rationale is for a society that invests so heavily in education that the fertility rate falls to below 1. I mean, that's a society that's going to be very highly educated until it goes extinct, which happens, you know, pretty quickly if you reduce your fertility rate down to 0.5 or 0.6.
It begs the question of what, if anything, governments through their policies can do to affect this. Obviously, we have the one-child policy in China. They're trying to change that, not so easy. But we hear, for example, in the United States, the suggestions that things like child tax credits, subsidizing, making working more flexible, may in fact encourage more births. Do we have any evidence that, in fact, those things might be effective?
Pretty much none. I mean, governments have been trying to do this since nearly 100 years ago. It was Mussolini, when he was the Italian dictator, who talks about a battle for births. And all kinds of incentives were created by the totalitarian regimes of the mid-20th century to increase the birth rate. None of it worked. It would seem that once people have got down to 2 children, it's extremely hard to get them back up to 3. When they're down to 1, it's hard to get them back up to 2. So I think it's very hard to find any evidence of a successful economic policy that changes the decision-making that couples make about family size. And this is a big problem if you're Xi Jinping and you're staring staring at this dramatic decline in population. It's already begun. I mean, the workforce is already shrinking. And so the one-child policy, which was one of the more dramatic interventions the Chinese Communist Party did back in the days of Deng Xiaoping, has been replaced by a three-child policy. But I can assure you the number of Chinese couples I know who are planning to have 3 children is tiny. And it's highly unlikely, in my view, that China will be able to increase the fertility rate back above 2. If you assume that the fertility rate stays where it is in a country like China, then actually the population will fall even faster than 50% between now and the end of the century. And the thing that's really striking, David, is if you look beyond 2100 into the next century, what's really amazing to me is how quickly global population could decline. We shot up from 2 billion back in the early 1920s to where we are today with astonishing speed. And indeed, the last 100 years was one of those periods of population explosion. You can see why people in the 1970s started to panic about it. Well, get this, if you fix that problem so much that fertility falls well below the replacement rate, then the population of the world could fall with almost comparable speed. Certainly between now and the end of the century, nearly all the increase in population in the world is going to come from sub-Saharan Africa. And after they bring their family size down, which it's highly likely they will, there just won't be any sources of additional population. And that means the immigration option will no longer really be available for countries that want to continue to grow.
But talk about that immigration option in the interim period. What ramifications does that have? As you mentioned, the United States actually has been maintaining its population growing because of immigration. What does this mean for immigration policy in places like the United States and other Western countries?
Well, it's relatively easy if you can just get the politics right, because there's obviously a competition for talent in the world, and the talent that's in relatively poor, relatively crowded countries want, and you can tell this from opinion polls, to come to the United States, and if it can't make it to the United States, to Western Europe or the UK. But the United States has taken the rather odd decision to make it really difficult to migrate to the United States legally. I mean, all the kind of legal channels are more or less blocked at the moment, or extremely hard to navigate. And so we've ended up with this curious strategy of allowing illegal immigration across the southern border, which is now pretty much a scene of chaos. The Canadians must be looking at this with a smile, because their immigration policy is much more targeted on attracting talent and making sure that the immigrants are likely to add to economic growth and not to be a cost of some kind. So I think for Western countries, there's an obvious argument for immigration reform that aims at attracting the right kind of people with the right kind of talents and doing it through legal channels rather than just having a free-for-all on your border. I mean, I think that's the critical issue, but we have to understand that this is not something, a gift, if you like, that will keep on giving indefinitely. Sometime around the 2060s, the supply of immigrants, of potential immigrants, is going to look like it's declining. And I think there'll become an increasingly heated competition for the people with the talent, the entrepreneurship, between countries that still want to attract immigrants. Remember, not everybody wants to do this. China does not have a policy of attracting immigrants, and relatively few, if any, people choose to migrate to the People's Republic of China. So what are the Chinese going to do? If they don't do immigration and their population is heading towards dramatic contraction, the answer may be robots. And I tried to sum up the future of the world by saying that the Cold War II challenge, the rivalry between the United States and China, may end up being immigrants v. robots.
That was Niall Ferguson of the Hoover Institution. Coming up, it's been quite a year for American higher education as on-campus demonstrations turned into a job hazard for college presidents. We talked with Marc Rowan of Apollo, one of the outspoken critics of what went on. That's next on Wall Street Week on Bloomberg. This is Wall Street Week and a special episode looking back on the year so far. I'm David Weston. American college campuses spent the spring in turmoil as demonstrations against Israel's war against Hamas turned into encampments. and presidents of major universities were called before Congress to explain what had gone wrong. Marc Rowan of Apollo has been a strong supporter of his alma mater, the University of Pennsylvania, but turned to be one of its most vocal critics. And we talked with him about what triggered the change.
Look, I think we've actually seen a lot of change take place over time. So I have a very favorable memory in my experience at the University of Pennsylvania campus. But think more broadly. U.S. universities were and are the envy of the world. We can destroy that. We can lose it. Why are kids there? Why did we think they were there? Be exposed to different points of view, learn how to think, critical reasoning, critical thinking, maturation. Is that what they're getting today? I think in some places it is what they're getting, and in some classes it is what they're getting. But what I saw at the University of Pennsylvania and when I spoke out against was a dominant narrative that was taking hold on our campuses. Call it a post-colonial education, call it what you will. It gave rise to an institutionalization of a point of view that there were favored groups and disfavored groups, that there was acceptable speech and non-acceptable speech. I'm not sure that's the job that we all signed up for, or that's the university that we signed up for. What we're watching today on these campuses is nothing more than the outgrowth of 20 years of bad management. If you have a dominant narrative on campus, do you have academic freedom? Do you have freedom of speech? I have seen over the past few years, as I've really stepped up my involvement, professors, department chairs, who are afraid to speak their mind because their thoughts, their speech, goes against the dominant narrative. What we're watching today on campuses, we're told, are leftists. We used to think leftists were liberal. This hardly seems liberal. This actually seems illiberal in the most extreme way. Why haven't they been cleared out? Well, listen to Ben Sasse at the University of Florida. We're all about free speech. We're all about the right to protest. But there's a time and a place and a way. You violate and trespass, there are consequences. Why would we not deal with them everywhere in that way? Certainly, protests that were inconsistent with the narrative that we find on our campuses have and will be dealt with in that manner. Speakers are regularly shouted down. Professors, university administrators who did not react in that way without that kind of moral clarity, they now have encampments. Once you have encampments, you have the potential for violence. You have other considerations that come into play. But make no mistake, outside agitators, not mostly students, trespass, danger to the rest of the students and the rest of the community. This is what 20 years of a dominant narrative has done.
These are not corporations, but if they were corporations, what you just described to me, I would say there's a failure of management in some. I'm not saying necessarily all, but in some, a fundamental failure of management. Having seen it from the inside, where is the failure?
The failure's in multiple places, but I think it starts with me and with us as trustees. We were asleep at the wheel for 20 years. Part of our job was to provide balance. I do not think the popular frame of a campus today where trustees and alumni are fighting professors over academic freedom is actually correct. I actually think the appropriate frame is university administrators who maintain this dominant narrative are fighting professors for academic freedom. Trustees and alumni are here to provide balance. We have been asleep at the wheel. We have not done what we were supposed to do. We did not object as these dominant narratives took hold, and it is our job, I believe, to support long-term excellence in education, academic research, freedom of expression, freedom to disagree. That's not what we have on many of our campuses today. We've gotten a long way from academic excellence.
How is that corrected without the trustees overstepping their boundaries? I mean, you know and I know, when you sit on a board, there are certain things you really need to do. You don't want to run the thing day to day. You don't have trustees there to be micromanagers. How do you have the proper role for the trustees without overstepping boundaries?
There's a question of overstepping. I think the danger right now is far from trustees overstepping the bounds. I think trustees, for the most part at these big institutions, myself included, have failed to act. We have not done our job in the most fundamental way. I don't think we are anywhere close to the line of overstepping our bounds. Most universities operate in a shared governance manner. Transparency is often the best disinfectant. I do not believe at the University of Pennsylvania or many of these campuses, the vast majority of professors actually believe in this dominant narrative. We as trustees can assure anonymous polling, representation across the faculty, lots of other things that we can do, in addition to just exercising common sense. But ultimately, the job of a trustee is to pick a leader and to provide that leader with some notion of strategic plan. Picking good leaders goes a long way. Developing a strategic plan goes a long way. And as you said, it is not the job of the trustee or the alumni, for that matter, to run these universities. This is best left to professional administrators.
This all comes against the backdrop of increasing questioning of the price of a college education and whether it's worth it, whether you get the return on investment you deserve. As the value, at least in some of these institutions, actually gone down of the investment. And will there be a market correction as people start to say, you know what, it's not worth it to send my kid, I'll pick on a college right now, Columbia, when they can't graduate at commencement?
Right. Very unfortunate situation. I don't want to say value has gone down. I think value's been dispersed. So if I look at our industry as a microcosm, we, 30 years ago, we hired from a very narrow subset of universities. You know what? There are 50 great places. There are not 8 or 10 great places. There are 50 great places. So we're watching the value of an education democratize. We are, as an employer, and I know our peer group as employers, increasingly going to places that we had never gone to before. Why? Because the end product is excellent. And it is not, we do not take for granted that because someone went to one of 10 schools, they actually received an excellent education. We do not treat people as groups. We actually treat them as individuals. Imagine the novelty of that.
As you said, Marc, I think Brandeis said that sunlight is the best disinfectant. There seems to be a lot of sunlight right now on college campuses. Could this actually redound to the benefit of our higher education system, actually, as we really are exposed to this, we debate it publicly, and we make some reforms?
Look, for me, I'm an optimist, but I am incredibly hopeful that this is a moment. As much as our college presidents and leaders are suffering under congressional inquiry right now, it's only because what they've done historically can't be defended. Imagine if they actually got up there and they had something to say, this is how we run it, this is our goal, this is our plan, this is how we make sure the kids are protected and also challenged. Being called in front of Congress is only a negative if in fact you have something to hide. I think in academia, we've done a very poor job in the past 20 years. We've got a lot of mistakes to rectify, but I do hope this is a sunlight disinfecting moment of going forward.
One of the things we've seen actually is donors now saying we're going to withhold donations. You've been involved in that as well, but it goes well beyond Penn, well beyond you. Do you think that's having any effect? Can you see any tangible effect in any of these colleges?
Yes. I'll leave it there over time. Look, people generally do not support those things that are against their fundamental interest. They may do it for a small period of time where they actually don't know. I think what we've seen in the past year, donors are now on notice as to what their university or college is or is not doing, and they will elect to fund or not fund places in which they believe are consistent with their values, consistent with their principles. For me, I'm hopeful that these big institutions are going to change. I know there are a number of entrepreneurs who have simply looked and said, these places are never changing. Let's start the institutions of the future. And they've attracted some really good, really important faculty. But let's not also forget, technology is changing these institutions. Technology is democratizing access to knowledge. You know, to think that any industry, even academia, is immune to the forces of change, I think it's just naive. I think this is a good opportunity for our universities to have a come-to-Jesus moment and really think about what the future is for them and who they want to be.
That was Marc Rowan, CEO and co-founder of Apollo Global Management. Coming up, the summer may be ending, which means for many of us that our summer reading lists turn into our fall reading lists. We talked with some prominent readers about what they recommend. That's next on Wall Street Week on Bloomberg. As the summer turns into fall, it's time to go back and check on what we didn't get to on our reading list. Here's some of what our leaders on Wall Street Week recommended during the year.
So one day, early on in my tenure, the person's a little late, so I actually go over and look at the books. And it's Tokyo on $5 a day. Kids, stuff that you leave, behind at a hotel, and it's a bed and breakfast. It is a mess. And I love libraries. I do read on a Kindle now, but we have 3 at our home in Chicago. I just love them. And I decided, Amy and I decided that's going to be our project. So I know you find it hard to believe, but I raised $150,000 for this initiative pretty quickly. And there's 2 things. So we redid about 450 to 500 books, all on the presidential history, great American literature and poetry, great American events. Then we did a section on both Japanese history, Japanese authors, literature, etc. And it's a traditional Americana, beautiful library with gold at the top, and it's all walnut wood paneling, if you can kind of put that in your mind's eye. And the books are worthy of the library, and the library is worthy of the books.
Not surprisingly, Rahm Emanuel is quite a reader. One of the books he recommends highly is about the plight of males in our society today, Of Boys and Men by Richard Reeves.
On kind of sociology, the 2 things that I do this, one of boys and men. I think we have a challenge at home, specifically among boys and men. And I think I always do one sociological book. This year I went back, Bowling Alone. You know what year it came out? 2000. And when you think about where America is, you think about the opiate crisis, you think about the lack of community, etc. How one professor, looking at data 3 turns ahead, realizes where America is going.
Economist Jen Doliak of Arnold Ventures spends her life researching and then writing up her results. So she pointed us in the direction of a book about the difficulties in the creative process and how to overcome roadblocks. The War of Art by Steven Pressfield.
So one of my all-time favorites is called The War of Art by Steven Pressfield. I was a longtime researcher, which meant my job was mostly writing, still is in many ways. And this book is basically all about how if you are engaged in any kind of creative pursuit, you have to just show up and work every day. Have a routine, show up at your desk, be a professional. Waiting for inspiration to strike is not the way any professional writer or creative is actually going to have their big ideas or get things done.
As president and COO of Blackstone, John Gray spends much of his time dealing with challenging situations, but not half so difficult as those faced by the survivors of the 18th century shipwreck told in the book he recommends, The Wager, a tale of shipwreck, mutiny, and murder.
More recently, I read The Wager, which was about a failed British expedition to chase down some Spanish ships in the 1740s. And I'm often interested in these people who face incredible challenges, and when they survive, and that perseverance. Shackleton was like that as well. You know, in business and investing, oftentimes things go wrong. Not as bad as those books, but you learn a little bit, and you want to be smarter how to deal with crises and challenges.
That does it for this special end-of-summer edition of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.